Welcome to our special webinar series, Insight into ETFs. I'm your host, Pallavi. Through this session today, we will try to understand how investors can use ETFs or exchange-traded funds in their asset allocation. I'm happy to be joined by Mr. Swarup Mohanty, CEO of Mirae Asset Investment Managers. Welcome to the show, sir.
Thank you, Pallavi, for having me on your show.
So as we know, ETFs, exchange-traded funds, they really provide us with the diversification. But how do they really help in building a sectorally diversified portfolio?
Pallavi, see, the exchange-traded funds or the ETFs can be different types. Some of them may track broad market or broad-based market indices, such as the Nifty 50 or say the Sensex 30 index or the index as we call it. Whereas others may track specific sectors like IT, banks, the broad BFSI, etc. In case of ETFs mimicking the broad-based indices, your portfolio is already sectorally diversified, as these broad-based indices represent companies selected across various sectors of the economy. Say, let's take the example of Nifty 50 index, which tracks the portfolio of 50 companies selected from 13 sectors, or say the Nifty 50, the Nifty Mid-Cap 150 index, which tracks 150 mid-cap companies that represent 18 different sectors. One can also, take ETFs for tracking specific sectors to add into your portfolio. For instance, if your active fund portfolio is currently underrepresenting one particular sector that you believe might do well, you could add that from the ETF side and form a more comprehensive portfolio as a way of looking at things.
Sure. In fact, among the many advantages, asset allocation, which is offered by ETFs, remains one of the biggest benefits of ETFs. So help us understand, how do they really create long-term wealth for investors?
ETFs are an excellent tool for building strategic asset allocation, which dominate your long-term wealth creation process. ETFs just try to replicate the benchmark, and hence the risk of underperforming the benchmark is mitigated in general when you invest in ETFs. And that's one of the biggest benefits or the way or why people sort of select ETFs in their portfolios. Since they replicate the benchmark, they're generally low cost in nature. The cost component can be an impact on your corpus in the long run because of compounding. Apart from being a low-cost solution, you can use ETFs for doing an international allocation, for taking exposure to alternate asset classes such as gold, etc., into various commodities. Further, ETFs can play an important role in deciding a core and satellite portfolio strategy. We recommend that tremendously. For instance, if you are an active investor, you can form your core portfolio into active funds, which you believe can beat the benchmark, and form the ETFs as a form of your satellite process. Whereas you can also use the ETFs tracking broad indices as part of your core portfolio, and use active funds as satellites to provide a better, stronger portfolio, which can generate slightly higher alpha. And you do not intend to deviate too much from the market or the benchmark. Also, to add the long-term structural and mega trends that emerge globally. Say one we talk about mostly, say the ESG. You can take through the ETF route. Technological advancements now, such as cloud computing, robotics. These you can take through the ETFs, and they completely enhance your asset allocation strategies tremendously.
Surely. In fact, but if we compare it with the passive investments, and if we see ETFs and index funds, they're really popular. So among these two, how do they differ? If you could help us, chart out the difference.
Yes, this is a very common question which comes up and is at a fundamental level. Well, one can take exposure via an ETFs through an index fund. ETFs are nothing but an index fund that can be traded on the index. ETFs hence can be bought and sold on the exchange at intraday at a net asset value, unlike index funds, which can be only bought at the day-end NAV, right? Also, ETFs can be bought in small quantum, representing single unit, just like stocks or the way you buy stocks in the market. Further, ETFs are also a more efficient vehicle than, say, the index funds. For an instance, an index fund, if someone wants to redeem an index fund, the index fund would redeem, an amount from itself and sell stocks of its own for cash to pay for the investors for the shares. This can result in cost and taxation for everyone who continue to hold the stocks in that portfolio. In case of ETFs, such redemptions can take place through exchange between the investors and the exchange, and also directly between the concerned investors and the AMC. And in case of lot sizes where transactions cost is slightly borne by the investor, and hence other continued investors are not affected, right? So hence we believe the final destination always is the ETFs, and it's better to go through the ETF route.
Sure, that's one of the good ways to create long-term wealth. But as we're comparing ETFs to other instruments, tell us what are the advantages which ETFs offer compared to other diversified investments?
Pallavi, I think the simplicity of the product is one of the biggest advantage of the ETFs. Apart from simplicity, the low cost, the tradability feature, the tax efficiency, the transparency of a portfolio on the day you buy, the focused exposure and accessibility in terms of an investor sitting in India also, and you look at it from an investor wanting to take global exposure into, say, the US markets, are some of the advantages in the diversified way this you can own the market through the ETFs route.
Right. In fact, if I may say, there are a lot of features in ETFs which are not fully explored or by the investors, or maybe they're not aware. So tell us, talking about market volatility, how does that affect mutual fund investors? Does that affect mutual fund investors more, and how? I mean, if we just compare these two.
See, volatility will continue to be a part of equity markets, and that cannot be negated. Higher the degree of uncertainty, greater the volatility. And in exchange for accepting the volatility, you get adequately rewarded by higher returns compared to other asset classes, such as, say, the fixed deposits, tax saving certificates, government securities, etc. Market volatility affecting mutual fund investors is more a behavior trait than an economic trait, right? Those investors who are using mutual funds for long-term wealth creation will continue to be invested irrespective of market volatility. Market volatility might cause investors to panic in the short run, like we are seeing at this moment post-COVID. And this reaction in short terms can be a bit there in the market, but its importance diminishes as investors' investment horizon increases. And that's how you play volatility in the market. Right. Always remember there is an opportunity in volatility, and that's what fund managers play on.
Sure. So in your opinion, what are the factors that have really made ETFs more acceptable by investors in the last few years?
See, Pallavi, we have to look at it from an Indian context, and though ETFs have been in existence in India for over 20 years, the growth in ETF actually can be witnessed in the last 5-6 years. Some of the major factors which have contributed to this acceptability has been, of course, the government using ETFs as a preferred route for disinvestment, and that has increased the participation of retail investors. ETFs are now being used by EPFOs and private PF trusts or bodies to take exposure into the equity markets. The shrinking alpha, and that's a debate which has come up lately in the active fund space, has even become more recognized amongst retail investors, and hence the shift to the plain vanilla ETFs like Nifty or the Sensex. And of course, the regulatory measures, you cannot discount this one, because the regulatory measures such as categorization of funds with benchmarking them against the total return index variance has improved the performance evaluation significantly. The shift where investors want to add ETFs into their portfolio along with active funds is largely because of consistent underperformance of certain sectors. That's something which cannot be denied and cannot be ignored also. While investing in active funds come with an expectation of alpha generation and hence the fees to active fund management, what has come out in the last few years is the risk of underperformance of the index from active fund management, right? So there is this new set of investors who want to avoid that risk of underperformance and prefer investing in the market, that is the index itself, through the ETFs.
Sure. In fact, talking about the different types of ETFs, could you help us understand which are the more popular ones and what is the reason behind that?
ETFs can be various types because as long as there is an underlying with an investable surplus or investable universe, there can potentially be an ETF. Globally, there are ETFs tracking broad-based indices, sectoral indices, fixed income indices, commodities such as gold, silver, etc. There are even leverage and inverse ETFs. Like I said, if there is an investable universe, there can be an ETF on that. And that's how broad it can be, which you were referring to just a few minutes ago. ETFs can be various types, and the most popular ones are the ones tracking the broad indices. Suppose, say, the S&P 500 or the Nifty 50. The most important reason for them being popular is over the time, markets become informally more efficient, and beating the benchmark becomes progressively difficult. And that's when the shift actually happens. That's happened globally. In India, alpha generation is still existent, so the shift is a little gradual. But once that sort of mitigates, the shift can be even more vigorous, is an opinion. Further, from when you look at global trends, there is a shift in investing in products. Earlier, one used to use ETFs only for the purpose of taking passive exposure in broad-based indices. Today, ETFs are preferred routes for investment vehicles for somebody who wants to capture and get benefit from particular themes, like I said, like say ESG, cloud computing, robotics, and artificial intelligence, etc. More and more ETFs are being adopted for their smart beta exposures too.
Okay, sure. So what we understand so far that ETFs, they offer an uncomplicated way to buy baskets of stocks, and that can really help in diversification into different sectors and different asset classes. Now, one very important question is, how do investors pick an ETF that aligns with their risk tolerance?
See, selection of ETFs, is aligning to investors' risk tolerance is very similar to selecting your mutual funds based on your risk appetite and your portfolio goal or your financial plan. If you want to stick to, say, only the large cap segment, you can evaluate ETFs tracking broad-based indices. Further, if you are particularly bullish on particular sectors, you can pick ETFs tracking such sectors and form a composite portfolio in this, basic core and satellite manner I had explained earlier. Both ways are possible. You can add the core as the active and add passives at the satellite side, or the inverse is possible. You buy the market or the broad market index as the core and build active fund management as the passive side. At this moment, India gives you this great advantage of picking both. And if you add both, in our view, you can build a stronger portfolio.
Sure. In fact, in terms of the risk and the return, could you tell us how equity ETFs, they score over equity mutual funds? I mean, what is your view on that?
Correct. See, as an investor, we intend to go with equity mutual funds in desire of higher returns than the benchmark. That is active fund management. This is a fair call too, as we all want to earn a little bit more than the average of the market. In doing so, as I referred to earlier, one also undertakes and accepts the risk of your equity mutual fund underperforming the benchmark. By investing in ETFs that track such benchmark indices, you mitigate this risk of underperforming the benchmark. You are actually buying just the market, right? So in terms of returns, ETFs will deliver the return of the benchmark, whereas equity mutual funds might give you higher returns than the benchmark, along with the possibility of giving you an underperformance of the benchmark. That is eliminated in the ETF.
Okay, sure. So as we can understand, the more cost effective, the more tax efficient, and there are other factors also. But if you are to give us like 2-3 benefits which are unique to ETFs.
Yeah, unique to ETFs would be, one can gain intraday activity. You can buy and sell ETFs at the real-time NAV on the market. You can adjust your asset allocation temporarily to benefit from current market and economic environment. They're very liquid and you can do so. One can do strategic allocation where ETFs form part of your core portfolio. That's some way away in India, but that's being done globally very, very well now. See, one can also use ETFs to park or to access, international markets. And that diversification is there for you earlier, through the mutual funds. And now that variation is there, but with sitting in India, you can take exposure globally through various ETFs as we speak. And one can park your money in ETFs till the time you finalize the right investment strategy, or till the time you finalize your fund manager. One can just buy the market and be in the market. So it's a very flexible way of investing. And once you learn the benefits of it and the liquidity of it, and you can use it whichever way you want.
Okay, talking about flexibility, tell us, are ETFs as flexible as mutual funds when it comes to liquidity?
See, I think first and foremost, there are two ways of buying an ETF. One is through the exchange, where you can buy as small as 1 unit, while the other way is buying it through AMC, where you can buy in a specific lot. That is a lot creation unit, and that is generally adopted by large or institutional investors. Buying ETFs on the exchange is similar to buying stocks, with certain things in mind, such as when you buy through the exchange, please check the order book. And please also check the price quoted on the exchange with the indicative NAV published on the AMC's website. Indicative NAV, which we call the INAV, will help you knowing whether you are buying it at the right price or not on the exchange, as the INAVs are the real-time price of the portfolio, excluding any transaction charges. That's something which one should keep in mind.
So what should be the ideal horizon? And, as you mentioned, these are the things that one should consider when buying an ETF, but is there anything that you want to add on to that?
See, Pallavi, finally buying into the markets is part of your financial plan. More than anything, it is the financial plan which is the ruler of your investments, and your goals are where you want to be. Always remember that the star is the goal, not the underlying. It's the underlying which take you to the goal. So please, there's nothing different in buying ETFs from the way you buy other market-related instruments. So please first, and this is my submission to all investors, first finalize your goal. And once you finalize your goal, a financial plan is developed from that based on your risk profile. And then you select what to buy. Invariably, that is where people make the mistake. They look at the most attractive sort of instrument. They need not need that instrument, is what I'm trying to say. What you need is your goal. Once you fix that goal and your plan, then buying the underlying is very easy. If you don't know why you are investing, you will never know where to invest.
Sure. So goal setting and having the goals cleanly set would be really helpful. So tell us, what are the things that one needs to keep in mind while is choosing the right investment for a holistic growth? As you said that first we need to be clear about the goals and then decide. So as I earlier also asked, is there an ideal horizon? Should it be 5 years, 10 years? What should be the approach?
So again, Pallavi, I'll come back to the basic question: is your goal will define your horizon. Right. If your goal is 1 year, then equity is not your space. Typically, we recommend equities for a period of at least 5 years and above. And below that, again, when you come back to the asset allocation, which is formed out of the goal, just give you a small instance. Suppose my asset allocation, say 50-50. The 50% is equity and the 50% is debt. Both sides, the approach has to be the same, right? If my goal for the debt side is 10 years, I should be allocating money funds which are 10 years in horizon. You cannot meet long-term goals with short-term investments. You only meet long-term.
So that has to be aligned.
Align your investment needs to the investment horizon of the underlying. The key, is to stay invested through that entire goal. The key is to do a good review of this portfolio. And if there are any rebalances required, do a rebalance ruthlessly. Sometimes when markets behave erratically are great moments for good rebalance. One should utilize that. But the key to remember is you are investing to reach a goal. Don't get away from the path of that goal is something which I'd like to leave behind.
Sure. So before we let you go, is there any piece of advice? You already shared a lot of insights about ETFs, but maybe, what percentage should ETFs, comprise of out of your total portfolio? Anything that you want to say on that?
We run both sides of the business, the active and the passive. And these are two different sides to the same market. It depends on the investor on what he or she chooses or what he or she is, comfortable with. If one is comfortable with the risk of underperformance of the benchmark, then one should be on the active side. If one does not want to take the risk, then you can use ETFs to form both, actually your entire portfolio. It depends on what suits you. Please reflect on what suits you and choose accordingly. Both the sides are there for you. And India is that one unique country which is giving you both sides simultaneously. The rest of the globe is graduated to practically ETF investing or passive investing. So enjoy both sides till they're there and form better portfolios looking at your basic financial plan.
Great. Thank you for sharing insights about ETFs and telling us how they can really help in building asset allocation in the long term. Thank you for this. Thank you for taking our time for this session. Thank you so much.
My pleasure, Pallavi. Thank you for having me.
This brings us to the end of the first session. We'll bring you some more insights into ETFs. Stay tuned with economictimes.com.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.